Are you constantly caught off guard by unexpected expenses, or maybe you end up having too much month at the end of your money? Imagine opening up your bank account and seeing a negative balance just when you needed it most. Don't let this nightmare become your reality. Let's make sure your finances are organized and that you can predict your cash flow in just 3 easy steps. Hi, I'm Jamie Trull, your go-to CPA for small business financial clarity. Today, we're going to dive into how you can forecast your cash like a pro without expensive softwares. And stick around until the end because I'm going to be sharing my most powerful tip for forecasting your cash flow at the end of this video. Now, importantly, when I'm talking about cash flow, I'm not necessarily talking about profitability. Even profitable businesses can struggle with cash flow because cash flow is all about timing. If you have expenses going out before your revenue is coming in, you're potentially going to run into a cash flow shortfall. That's what makes a cash flow forecast so useful because it's really predicting the future. You're going to look forward so that you can avoid any surprises and so that you know how much you can pay yourself and when from your business and take the guessing out of it. So let's go through those 3 simple steps to forecasting your cash flow. Now, step 1 is gathering your historical data, and I mean cash flow data. So you don't need your profit and loss for this. In fact, it's going to be best to go to your actual bank account. While the timing of when revenue and expenses hit our profit and loss can vary based on a few different factors, including some weird accounting funny business, as I like to call it, your cash flow is your cash flow. It's the amount of cash you have in the bank. It's how much is actually coming into your bank account and how much is actually going out. So thankfully, when we're looking at cash flow, we don't have to worry about crazy accounting concepts like depreciation or anything like that. So I recommend going to your business bank account and downloading a statement, probably as a CSV file, because that's going to put it into a spreadsheet format for you. And that's going to make it easy to look down through that list and see what cash came in and what cash went out in the past. Now, the past isn't always predictive of the future, but in some cases it can be. And once you have that list of what your transactions have been, you're going to look for those regular recurring transactions. So maybe they happen every month or maybe even just every 6 months, but you're going to be able to see which transactions happen, how much they're for, and you're going to get an idea of when you pay them. So once you have that long list of expenses and income, then you can go down through it and determine what are the recurring things. And you're going to want to make a specific list, probably in a spreadsheet format, where you're going to list out all of your recurring expenses. Now, what I mean by recurring are the regular things that you have. So maybe it's every single month you have this expense, or perhaps even just once every 6 months, or maybe even just once a year. But if they are ongoing expenses, you're going to want to write them down. And in that same spreadsheet, you're going to want to make some notes. So what you're going to do, for instance, is as you go down through, maybe you realize, okay, I pay my insurance once every 6 months in January and July, right? So next to that insurance expense that you put on the spreadsheet, you're going to write paid every January 15th and every July 15th. And that's going to help you remember that that expense is coming. And I'll tell you what to do with it in just a minute. Now, another important expense to look at is your credit card payments. So remember, we're talking about when these expenses actually hit your bank statement. And that's going to happen when you actually pay your credit card bill. So rather than tracking cash flow when you have the expense, if you're putting it on a credit card, it's not coming out of that bank balance until that credit card is paid. So that's the timing that you need to be thinking about when you're looking at those expenses. So this makes it a lot easier. Instead of having to list out all of those expenses separately, you can have one line that just says credit card payment. You can put an estimate based on the past of what your monthly credit card payment has been and when that credit card is due. Now, don't worry about trying to get this perfect. The goal is to have something to start with when you are projecting the future. So again, the past is not always indicative of the future, but it can help us to estimate and consider what could potentially be coming and when. Now, in step 2 is where you get to create your cash flow projection. Okay. Now, this may sound difficult, but I'm going to actually walk you through a really simple way to do it. I'm going to show you in Google Sheets. You can also do this in Excel or any other type of spreadsheet that you tend to use. And you don't have to make it super complicated. So I've jumped into Google Sheets now, and I'm going to show you that simple tutorial I talked about. So first of all, what I've done here is just put in some categories. So I started with the date, and then these can be whatever dates, right? And you can go out as far into the future as you want to, right? If you want to go out multiple weeks or months, or even for the entire year, you can absolutely do that. You also don't have to track this weekly. This could be daily. Especially if you're really worried about making sure you don't have cash shortfalls, then daily might be better for you. Or it could even be monthly if cash shortfalls aren't really a huge issue, but you still want to generally track what's going on with your cash on a monthly basis. I find weekly to be a really good happy medium, so that's what I use. Now, what you're going to do is when you're first starting this, you're going to take the starting balance, that's the balance in your bank account, as of the beginning of that first week. So whenever you're beginning this, that's the balance that we are talking about. So let's say that I have, 10,000 is what we'll put in as the starting balance. Then you're going to have sections where you put cash in. So this is the income that you're making. You can call this whatever you want, sales income. I just put a couple different categories. Let's say I have affiliate income, whatever it is. So let's say I make 2,000 in sales income and 1,000 in affiliate income. And then you're going to want to summarize this, right? So that you can see what the total cash in is, and you can carry this formula across just so that it continues to work for you. And then you're going to put in the total cash out. So these are all the expenses. And like I said, you might even want to start with credit card 1, right? And maybe you know that credit card 1 pays out on the 15th of every month. And so that's typically going to fall into, let's say, week 3. Now, again, it depends on what the dates are for these weeks. So you can put the actual dates up here to make this easier on yourself. I recommend doing that. I'm just putting week 1, 2, 3 for example. But let's say the 15th of the month, and that falls right here. And your typical credit card bill, let's say, is $6,000. Right? And then we're going to look forward and say, well, actually 4 weeks from then, it's probably going to be week 7. We're also going to have a credit card bill. Again, it's typically $6,000. In fact, by the time you're doing this, you may be able to see what the payment will be for your credit card. That's one of the nice things from a cash flow perspective about credit cards. As long as you don't overdo it with them, you can see, hey, I'm locking in my credit card balance. It's usually going to tell you what that is going to be about a month ahead of time, 3 weeks to a month ahead of time. So you should know by this point, if your credit card is due in 2 weeks, you're going to know what the payment for that credit card is. So you can go ahead and put that actually in here, which makes it really easy to plan. And then let's say you also have insurance, and we know that happens every 6 months, and maybe one of those is going to be during week 4, right? So remember how we wrote some notes as to when this typically happens? This is when that's going to come in very handy when you are figuring out where these are going to hit. Maybe you have payroll, and that payroll hits the first week of every month and the 15th of every month. So you're going in and putting that in, right? So again, you can kind of put what you know in here. Now, the hardest is probably going to be your income. Cash in is sometimes a little bit less predictable. It depends on your business model, maybe not so much for you, but you can go through and just carry forward an estimate. If you know, say you get a lot of affiliate income in the last week of the month, this might be obviously a different kind of income for you, but let's say you have some big payments that come at the end of the month. You're going to want to find the week that corresponds with the end of the month, and maybe you've got some bigger amounts coming in then. So again, estimates are completely fine here. We cannot predict the future. That's not the point. And if you're not sure, sometimes it makes sense to err on the conservative side, meaning I err lower in my assumptions on income and higher in my assumptions on expenses. That helps me make sure that even in kind of the call it worst case scenario, I am still covered. Now, you don't have to go full worst case scenario. I think it is most helpful if it's actually reasonable. But again, if you're in doubt, maybe go a little bit more conservative just in case. And then down here, we're going to sum up just the cash out as well. And we're going to carry that formula over so that it works in all the different columns. And then you have your expected cash in, your expected cash out. But now what, right? Now, how do we actually calculate what our cash flow is going to be? Well, thankfully, it's just a little formula. So you're going to want to put in an owner's draw. If you plan to take an owner's draw at some point, maybe you take it at the end of each month. You want to take a $3,000 owner's draw, right? Let's put that in for now. and see how that goes. And then let's say, for changing cash, we're gonna do a calculation on this. So the change in cash is just gonna be your cash in, right? Minus, because we're gonna put these in positively, so it's minus your cash out, minus your owner draw. Now, if you do these minuses like that, that means you want everything in here to be positive, right? If you've entered your expenses in negative, then you're actually going to add them back. So just make sure you're paying attention to the signs so that the change in cash makes sense. And in this case, it actually does, because I had $3,000 in and $3,000 out. So my change in cash was 0 because I didn't pay myself an owner draw. And then your ending cash balance is just going to be this beginning cash balance plus your change in cash. Okay, that's going to give you your ending cash balance. In this case, it's still the $10,000. And then here's the trick to this whole thing. Okay, what you're going to do next is first of all, you're going to carry this change in cash calculation over. That's really important, right? We need to make sure that this change in cash is being carried all the way over and the formula is still working. And then you're not actually going to type in the new bank balance each and every week, because if you do that, we don't know obviously yet. If we're in week 1, we have no idea what those additional cash balances are going to be. That's the point of what we're doing. So instead, we're going to link this starting cash balance to the ending cash balance we calculated down here. Okay? And then we have to make sure we've carried all these ending calculations over as well. But then when we do that, we can carry this calculation over, and it's basically just going to be linking, right? This one links to the end of week 2, and then week 4 will link to the end of week 3. And that's going to show you what your starting bank balance is for each week. And then down here, you're going to be able to see if you have any cash shortfalls, right? If they're all positive, that means you're good. You're not going to be, at least in the next 7 weeks, you don't expect to be running into any issues. Now, what if we wanted to make a big inventory purchase, right? And we were thinking that we want to make it, maybe it's this week. We're going to go ahead and take advantage of some bulk offers and buy $10,000 worth of inventory in this week, right? Well, now we have put ourselves in a bit of a pickle, because now we're only at an ending cash balance of $300. That's not too bad, right? That we can actually sustain with that. Depends on how much you want to keep as a buffer. I do recommend that you keep a buffer in there, but ultimately you're still not going to run into any negatives. However, down the line, that will create a negative. The next time you try to take an owner draw, you're not going to be able to take as much as you want because you're not going to have enough money in there to do that. So you'll be able to see that, you might think, okay, I'm good. I've got enough cash in my account in order to buy this. And you might be right. In that current week, you're okay. But 3 weeks from now, it's going to come back to bite you, right? 3 weeks from now, you're going to run into a shortfall. And so that's really good to know. So maybe you decide to say, okay, I'm not going to buy all of that inventory. I'm going to do about half of that inventory and I'm going to wait for the rest in order to be able to make sure you don't run into any shortfalls and that you're not taking away from your own owner draw. That's what tends to happen when we don't have the money, right? When we haven't done projections like this, then oftentimes the one to suffer is us. So if you put in that $10,000 in inventory, let's say you decided to buy it and everything was fine that week, but then you got to week 7 and all of a sudden you're sitting here realizing, oh shoot, I don't have enough money in my account in order to pay myself my normal owner draw. So you're going to have to sit and only take maybe $1,000 to make sure that you don't overdraw your bank account. And we don't want to be there. So again, having that line of sight that couple weeks early can help you make decisions so that you don't end up not being able to pay yourself, not being able to pay your bills, not being able to pay your payroll, not being able to pay your credit card, right? This gives you that line of sight forward. And if you do see a lot of shortfalls, then it's about sitting and thinking, how can I bring up collection of my cash, right? How can I bring cash in sooner? And how can I maybe delay some expenses? So when you have this information in front of you, it makes it a whole lot easier to do that. So that's a really simple example of a cash flow forecast, but it can be super effective. And cash flow forecasting softwares cost thousands of dollars in ongoing fees a year. And so doing something like this can give you the same exact results for pennies on the dollar. And if you don't want to spend the time setting this up yourself, I get it. Maybe you're just not a spreadsheet person. That's not your thing. I've created one for you that you can go ahead and buy. It costs less than just 1 month of that software subscription fee I was telling you about, and you could use it forever. So this is my brand new deluxe cash flow worksheet, and you can see that we include tons already in here created for you. So I've made this. We have options for daily, weekly, or monthly tracking. And not only that, we have added a similar but slightly modified version for you to also be able to track your personal expenses. And you can even track anything that you want to transfer into your savings from your personal bank account. So the goal is to be able to use this to meet your cash flow goals in your business, which then will help you meet the cash flow goals for your personal life when you can pay yourself more in your owner distributions and draws. So the goal here is to be able to use this worksheet to help your cash flow in your business, which then helps your cash flow in your personal life, which then helps you to meet your savings goals in your personal life and for those longer term goals and dreams that you have. So if you're all about saving time, go ahead and go to jamietrull.com/cashflow and get your worksheet. So let's move on to step 3, the third and final step of creating your cash flow forecast, and that is monitoring it and adjusting it, right? Remember, we are making guesses. The farther out we go, the harder those guesses are going to be. So hopefully we have a fairly good line of sight, maybe on this week, maybe on next week, but we're going to get out there and we're going to have to make some predictions. And so as you go along, you're going to want to update that forecast. And the closer in time you get, the more accurate it's going to be. So I do this in less than 10 minutes a week. I promise once you kind of get it all set up, you're going to be able to do it a lot quicker. So every week I'm jumping in, usually at the beginning of the week, to see how did last week go versus what I expected. How does that impact my cash flow forecast? In my tool, I actually have a bank override, so I can override that bank balance and true it up to what my bank actually says instead of having to go back and plug in all of the actual information. This is great, especially if you miss a couple of weeks, which happens to the best of us. And then you can go in and update whatever you need to. And for me, I know that typically, when I'm 1, 2, maybe 3 weeks out, I can predict it relatively well. But as we get further out into the future, I'm guessing a little bit more, which is totally normal and okay, and why it's important to keep monitoring and adjusting your cash flow forecast as you move forward. But this information that it's going to give you is so beneficial to your business overall, and making sure that you have line of sight onto whether anything you're doing in your business, paying certain bills, paying yourself, is going to potentially put you in a cash shortfall position later on. And then knowing that now you can make decisions thinking about that, and you can make decisions in order to be able to combat that and perhaps not have a cash shortfall happen at all. Now, as much as I love profit and losses, my cash flow worksheet is probably my favorite thing in this business. I use it all the time. It is literally a crucial element in tracking my finances. And in fact, if you're interested in this worksheet or just cash flow forecasting in general, you're going to want to watch my video from last week, which goes over exactly what I do every single week with my cash flow forecast. And it'll give you more of a deep dive into the features that are built into this worksheet. So definitely check out that video next. It's up on your screen, and go grab the cash flow worksheet, jamietrull.com/cashflow. I'll see you next time.